this fiat debasement has gone from small to really significant, and it's gotten on a life of its own. Like, I think there is no way out at this point. We've tried everything. The government's just going to keep spending money. It's the only thing we agree on as a country, is we should print and spend more money. And so I think you need a little bit of insurance, and Bitcoin is exactly that. We think institutions are going to allocate a significant amount of capital to this space. You know, the World Bank says there's $100 trillion in institutional assets under their control. We think it could be 1 to 5% in Bitcoin because it is such a nice addition to portfolios. That's $1 to $5 trillion of investment. You know, right now Bitcoin ETFs hold 170 billion. That means we have a long way to go. So I think they see it as a very exciting asset, an important asset, and one that they're going to allocate to in the coming years.
For most of us, debt and deficits have always been background noise in U.S. politics. But since COVID-19, the situation has spiraled into something far more dangerous. The United States is now running 6 to 7% budget deficits during times of economic growth, not during recession, but in expansionary times when deficits should be shrinking. To put it into perspective, just the interest on America's $36 trillion debt amounts to $6,000 per taxpayer every single year.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Growing up, we always had debt and deficits and we worried about it, but since COVID, it's exploded. We're running 6 or 7% budget deficits during times of economic growth. Just the interest on the debt amounts to $6,000 for every taxpayer in the US every year. Just the interest. That's like the minimum charge on your credit card bill. And that keeps compounding because we keep spending more and more money. So, you know, the need for insurance is directly related to the scale of the risk. I live in California. The need for fire insurance is high because we have a lot of fires and the conditions are ripe for more fires. In the US, the need for insurance against this fiat debasement has gone from small to really significant, and it's gotten on a life of its own. Like, I think there is no way out at this point. We've tried everything. The government's just going to keep spending money. It's the only thing we agree on as a country, is we should print and spend more money. And so I think you need a little bit of insurance, and Bitcoin is exactly that. Institutions are increasingly looking at it. That's the first and most important point. As I mentioned, we received more than a dozen requests for this report. That's because institutions are looking at it. Or if you just think from a big picture perspective, crypto is now a $4 trillion market. That's too big for institutions to ignore. So to get to your question, what do they see when they look at it? They see an asset that has high historical returns. They see an asset that is historically pretty volatile, more volatile than stocks. They see an asset that is liquid. And importantly, they see an asset that dances to its own drummer, that's not correlated with stocks or bonds. It moves in different ways. And when institutions build portfolios, what they're looking for is a combination of assets that work together and where the sum is greater than the parts. And the key to that is having these assets that move in different ways, right? That's why they bought US stocks and international stocks. That's why they buy stocks and bonds and real estate. And crypto is another one of those vectors. So we think institutions are going to allocate a significant amount of capital to this space. You know, the World Bank says there's $100 trillion in institutional assets under their control. We think it could be 1 to 5% in Bitcoin because it is such a nice addition to portfolios. That's $1 to $5 trillion of investment. You know, right now Bitcoin ETFs hold 170 billion. That means we have a long way to go. So I think they see it as a very exciting asset, an important asset, and one that they're going to allocate to in the coming years. Companies now hold about $8 trillion in cash on a global basis. If you think 10% of that is coming into Bitcoin, that's getting pretty close to $1 trillion, right? Again, the whole asset, Bitcoin as an asset, is $2.5 trillion. So $1 trillion of buying power. which you could easily see from corporations over the next handful of years, is a really lot of money, right? Companies have a lot of money and they're worried about debasement just like the rest of us. I mean, limited supply is the key of Bitcoin, right? There will only ever be 21 million Bitcoin. There's about 19.5 million that's already owned. And every year right now, the inflation rate of Bitcoin is about 0.8%. In other words, about 164,000 Bitcoin get created every year. That's it. That's important in a couple of different perspectives, just to put it in context. One is that compared to gold, it's actually much more scarce, right? The average inflation rate of gold is, call it 2%, sometimes 3%. So Bitcoin today at 0.8% is significantly more scarce. And importantly, that's going down. Gold's inflation rate has stayed roughly the same for the last 100 years because people can mine, they can open new mines, they can discover it in new places. There's no discovering a deposit of Bitcoin. There is only this 21 million, and the amount of new supply is actually going down over time. The report is relatively sophisticated, but if you wanted to boil it down, you could say there's only 164,000 new Bitcoin per year right now, and there is more than 164,000 Bitcoin of demand from institutional investors. There's more demand than supply, and so the price goes up. I think that is a core element of Bitcoin. It's demand, inelastic, supply, just a fixed amount. Regulation is still a risk. We've made a lot of progress on regulation over the last 2 years, and that's been reflected in Bitcoin's price going up. But regulation is made by humans, and humans are imperfect and subject to different forces. It's entirely possible that we could see some of the positive regulatory strides we've made in the US and elsewhere be reversed in the future. It's very possible we could see regulators introduce new legislation, or legislators introduce new legislation that is harmful to Bitcoin. I would just note that today's risk is tomorrow's alpha. And I don't mind that there is still all of these risks in crypto. My best guess is the future track of regulation and legislation is more pro-crypto than anti-crypto. And I think if that comes true, it'll be recognized in the price. I think the perceived risk of quantum computing will fall over time rather than increase over time as quantum resistant cryptography improves in the space. And as these things happen, that accretes to the price of Bitcoin. So there are real risks. It's a risky investment. People should recognize that. But the flip side of that risk is potential return. And Bitcoin has de-risked a lot over the last 10 years. That's one of the reasons it's gone up so much in price. You can harvest that volatility. And it's a whole theme of thought in terms of rebalancing to sell a little bit when it's up and buy a little bit when it's down, and it's transformative to the asset class. I tell people sometimes it's like hot sauce. I like a little bit of hot sauce on my food, but if I had a whole plate of hot sauce, it wouldn't be a good thing. So yes, there is risk. I would also say, and don't forget, you're also hedging another massive risk in your portfolio, which is all of your other assets are exposed to dollar and fiat currency risk, and that's currently an unhedged risk. So I agree, you can harvest that volatility. It doesn't bother me. It's part and parcel of an asset that is the best performing asset in the world. And so I take that volatility and risk as it comes.
All fiat currencies eventually fail. Even silver-based currencies failed because coins could be clipped. Once governments have the easy button to print more money, history shows they always do. Hougan highlights a sobering statistic. In his lifetime, he's 49 years old, the US dollar has already lost 85% of its value. Since COVID alone, it's lost 30%. That's the silent tax of inflation eating away at living standards. And today, interest payments on US-backed debt are now the third largest federal budget item, bigger than defense. That's a crisis-level problem, and there's no obvious way out.
Bitcoin doesn't generate cash flows, right? The reason stocks has value is they generate cash flows. And people always ask me, how do we know Bitcoin is worth anything? How do we know it has any value? And the framing that I used in that write-up is that from my perspective, Bitcoin just provides a service. And the service is the ability to store wealth in a digital format without a government or a bank. And today, hundreds of millions of people around the world want that service. The reason this is a clarifying way to think about Bitcoin, again, it's a service, the ability to store wealth in a digital format without a government or a bank, is because we're used to services having value. If you think of any company in the world, let's think of Microsoft. Microsoft provides a service, which is the ability to edit Word documents and do Excel and do Teams calls. And people pay Microsoft to access that service. If you want Microsoft's service, you buy a subscription to their software. The more people who want that service, the value of Microsoft goes up. The fewer people who want it, the value goes down. And critically, if no one wants Microsoft's service, the value of Microsoft is zero. The same thing is true of Bitcoin. The more people who want this service, the ability to store wealth in a digital format without a government or a bank, the value of Bitcoin goes up. If fewer people wants it, the value goes down. If no one wants it, the value is zero. The difference is you can write a check to Microsoft because it's a company with a CEO and employees. You can't write a check to Bitcoin. There is no CEO of Bitcoin. The only way to get the service that Bitcoin provides is to buy Bitcoin. If you buy Bitcoin, you get the service. But other than that, it's simply identical. More people want it, the value goes up. Fewer people, the value goes down. No one wants it, the value goes to zero. What we show in this report is that more and more people want this service. And with US debt at $36 trillion and growing, with money printing going around the world, I think more and more people want the service of storing wealth in a digital format without a government or a bank. And that's what creates the value of Bitcoin. It's so true, and it's so poorly understood. We say these things about gold like it's existed in this one format versus fiat currencies for thousands of years. And that's because most people don't remember or haven't studied gold pre-1971, right? It was $35 an ounce for like 50 years. And before that, it was $22 an ounce. There was a one-time revaluation, and that was fixed, right? Like a flat line. Pull up a fiat, an actual dollar line of gold, and it's just like flat line up, flat line. And then in 71, it goes crazy. Because in 71, we severed that, and suddenly it was measured against fiat currency. One of the things we show in the paper, which I think is really interesting, we think there are a lot of analogies for gold in the 70s and 80s versus Bitcoin today. Again, I know we all think gold is this timeless asset, but in the 70s, there were real questions about what role it would play in society. People described it as a barbarous relic, like something from the past that was no longer relevant. And if you look at the price, what you saw is the price went way up. You know, it went from $35 to over $800. Part of that was inflation, but part of that was the world discovering that gold had a place in society. And once it did, the value of it went up. I think the same thing is happening in Bitcoin. People are discovering that Bitcoin has a place in society and the value of it went up. What we note in the paper is that over time, from about 71 to 97, gold's volatility declined as people came to accept it. Right? In 1970s, it was hugely volatile. We think of it as steady today, but it moved 3% or more every third day. It was hugely volatile, but that volatility declined over time. I think the same thing is happening in Bitcoin. Its volatility is declining over time. Eventually, it will reach some steady state where it's much more valuable than it is today and lower volatility. But yeah, I love that you bring it up. There's so many parallels between gold in the 70s and Bitcoin now that I think people could do themselves a favor by studying it. All fiat currencies fail over time. And even, silver currencies failed over time because people could physically clip the coins to create inflation. When you have the easy button, when you can just push a button to create more money, to spend more money, you're going to do that. And so, yeah, the track record of fiat currencies is just abysmal. I would add, yes, things are fine. I'm 49 years old. The dollar has lost 85% of its value in my lifetime. That's pretty remarkable, right? It's lost 30% of its value since COVID. People are struggling from a living standards perspective to keep up with those rising costs. And the problem really just gets more and more acute. I mentioned that interest payment. Interest is now the third largest item in our federal government. There's Medicare, there's Social Security, and then there's interest. And it actually comes ahead of things like defense. So the problem that we were worried about in the Reagan era and the Clinton era is now at a crisis level. You can think of it as from an individual perspective. If you have like $100 on your credit card bill, you're not in a crisis. But when you have $100,000 on your credit card bill, it's just impossible to get out of that for many people. And that's sort of the situation that we're approaching. So yes, we've been worried about it for a long time, but the pressure has increased dramatically as the scale of this debt has gone up so much. I think there have been two pretty fundamental changes in the monetary ecosystem over the last 15 or so years. One was after the global financial crisis, when we discovered the tool of quantitative easing. And that was not something that had existed in our vernacular. And that really led to a dramatic expansion of money printing. The second one was when the US government seized Russia's treasury assets, when they invaded Ukraine, which was really a signal to central banks around the world that, those assets aren't yours. You're sort of renting them. In the same way, some people are shocked to discover that they don't own the books on their Kindle, that they're effectively renting them from Amazon. It can be revoked. We found out that governments don't own their treasuries. The US can just take those away. And I think that was a shot across the world that central banks need to diversify into, assets that can be held on a sovereign basis. And that's gold. The other thing I would add, I think that's what's driving the purchases. One of the reasons I'm with Ryan that I think they'll move into Bitcoin is, if you think of the history of money, the reason people used gold instead of silver was that silver is too bulky. Gold is much more dense, stores much more wealth per unit. And so if you needed to move $1 billion of gold, you could do that. $1 billion of silver would be basically impossible. Bitcoin is infinitely more transportable, storable, movable, useful, divisible, etc. than gold. And so I do think over time, as this asset matures, you're going to see Bitcoin sitting side by side and then eventually, maybe someday, on parallel with gold in terms of central bank deposits. It's just a continuation of the idea of more dense, transportable forms of hard money.
Matt Hougan's message is clear. The debt crisis is real, inflation is persistent, and the world desperately needs an insurance policy. Bitcoin, with its fixed supply, growing institutional adoption, and superior monetary properties, is emerging as that insurance. Yes, there are risks. Yes, volatility is real. But as with gold in the 1970s, these growing pains may be the prelude to Bitcoin cementing its role in the financial system. For investors, the choice isn't about betting everything on Bitcoin.